Welcome to our channel. Today, we're diving into the world of portfolio diversification. Whether you're new to investing or looking to refine your strategies, this video is for you. We'll explore the basics of diversification, understand why it's so important, and how you can apply it to achieve your financial goals. Get ready to discover how to build a solid portfolio resilient to market fluctuations. Let's dive in. But before we dive in, don't forget to like the video, leave your comment, and subscribe to the channel to stay always updated. Thank you. Investing can be a low-risk, high-reward activity if you diversify your assets properly. Do you want to minimize the risk of your investments while maximizing your profits? Of course you do. But you know there's always the risk of losing everything, even if you've meticulously studied the market and your stock choices. And there's a lot at stake here. Your early retirement and your kids' college fund depend on it. Money bag. It's easy to fantasize about buying the right stocks at the right time, and it can help you achieve all your financial goals. But the truth is, sometimes you have to play the long game right to reap the maximum benefits. Portfolio diversification is often considered the gold standard of investing. Even if you're not the most intuitive investor, you can often secure long-term financial gains with minimal risks. So, in this article, we'll discuss the logic behind diversification, as well as the best ways to do it according to your financial goal. Remember, there are many pitfalls. Before we continue the video, allow me to introduce an offer that can completely change your financial trajectory. Access the link in the description below and discover an extraordinary opportunity to earn money significantly and sustainably all through the internet. Don't let this chance slip away. Pitfalls to avoid when diversifying too. So, without further ado, let's get straight to the point. What you will learn. Definition of portfolio diversification. Importance of asset correlation. Reasons to diversify your portfolio. The dangers of over-diversification. Elements of a diversified portfolio. How to diversify your portfolio. How to diversify your 401k. Benefits of a diversified portfolio. Limitations of a diversified portfolio. Getting started with a broker. What is portfolio diversification? Open book. Think of it this way, if you had $1,000 to bet on a horse, would you bet it all on one horse? Or would you spread it out to increase your chances of winning? In essence, portfolio diversification is the strategy of not putting all your eggs in one asset basket. It's based on modern portfolio theory, created by an economist named Harry Markowitz. Markowitz won the Nobel Prize for this theory in 1990 and the John von Neumann Award the year before. The idea is that you're less likely to suffer long-term losses if you invest across various asset classes in different sectors. With proper asset allocation, you can cushion the impact of underperforming assets and maximize your profits in the long run. Many investors still use diversification strategies to manage their risks. By understanding the concept and what constitutes an ideal portfolio mix, you can invest confidently without bearing the weight of a poorly placed investment. Why is asset correlation important? Light bulb. In a well-diversified portfolio, you want your asset groups to have as little connection to each other as possible. The idea is to invest in different assets so that risk is minimized. But did you know you can also use math to determine the closeness between your assets? Asset correlation measures the degree of relationship between the price movements of two or more assets, with +1 indicating that your assets move together in terms of price and -1 to indicate they move in opposite directions. Theoretically speaking, your portfolio is safer if all assets are perfectly correlated -1. Using this representation, you should accurately predict how independent your purchases are from each other. As perfectly uncorrelated pairs are very rare in the stock market, your best bet would be to increase the distance between your pairs. For example, the correlation between assets A and B is +0.26. The correlation between assets A and C is plus 0.64. The correlation between assets B and C is minus 0.05. In this case, we could say that assets B and C are less correlated than the other pairs and therefore are the least risky of all. That said, it's crucial not to get lost in the numbers game details. There are always anomalies. Sometimes, a low correlation pair can be impacted by the same market changes and vice versa. The goal of calculating asset correlation is to get assets that are likely not to be affected by each other, so keep that in mind when selecting your investments. Why diversify your portfolio? File cabinet. First, ask yourself, would you bet everything on a poker game if you had only one good hand? When you put all your money into a single stock, you're banking everything on a probability that might not pay off. Companies in the same industry tend to mirror each other. If one fails, the other follows suit. Additionally, they can also be influenced by the same factors, such as new government regulations, ownership changes, or even unexpected scandals. You'll have a much better chance of netting a gain if you spread your investment across a few asset types and distribute them across sectors. This way, even if one of your investments performs poorly, you're likely still profiting from your other assets in the long run. The logic here is that a broad range of assets in different sectors is less likely to underperform simultaneously. They're more likely to offset and balance each other out when one misses the mark. As long as some of them soar high, you'll be able to reach your long-term goals with them. The COVID-19 pandemic is the perfect advocate for portfolio diversification. Let's just take Boeing and Zoom as examples. As you can see, Boeing lost about 60% of its value in just 3 weeks in March due to COVID fears, unfortunate accidents, and mismanagement. Meanwhile, Zoom is seeing unprecedented growth that doesn't seem to hit the ceiling anytime soon. Hindsight is 20/20, of course, but if you had invested all your money in airlines like Boeing or Delta, you would have lost a lot of money due to the pandemic's impact. However, if you diversified your portfolio and invested some money in Zoom, you'd at least make enough to cover your losses and even make some profit. Some might argue that putting all your money into the communications sector would yield a great pot of gold. But we all know nothing is truly certain in the stock market, as it's highly susceptible to changes. Besides a global pandemic, a vague shift in government regulations, CEO changes, or scandals are just a few factors that can cause a stock to plummet. Diversification doesn't just involve stocks. Defensive assets like bonds and commodities are significant investments for a well-diversified portfolio. They're generally considered more stable and secure, shielding you from sudden drops in the stock market. Additionally, a diversified portfolio would also require minimal maintenance. If you solely invest in stocks, you'll spend a lot of time studying market movement and analyzing your next move. The same goes for finding more ways to increase returns with low-risk bonds. The dangers of over-diversification: skull and crossbones. While not a foolproof strategy, diversification effectively protects you from unnecessary risks and losses. When your investment portfolio is sufficiently diversified, downturns in any one stock shouldn't significantly affect your overall gain. Many investors make the mistake of thinking that risk is proportionally reduced with each stock they buy. In reality, the more stocks you buy, the harder it becomes for your stock portfolio to perform optimally. For example, if your portfolio includes an S&P 500 index fund and a technology stocks ETF, you've likely over-diversified your portfolio. This is because tech stocks represent almost 28% of the index fund, making it counterproductive to acquire more tech stocks since they're all affected by the same factors. The dangers of over-diversification continued. It's a common mistake that investors make when acquiring a large number of assets. When your portfolio is too large, you're more likely to inadvertently purchase stocks highly correlated with your existing portfolio. This significantly makes it harder to achieve your financial goals, as your losses are more impactful than your gains. It's important to remember that diversification can only reduce risk to a certain extent. Due to the unpredictability of the stock market, diversification for the sake of diversification is never a good idea. Quality is always better than quantity. What makes a diversified portfolio? Open book. What's your ultimate financial goal? When do you want your investments to pay off? How risk-averse are you? By asking these questions, you can adequately allocate your assets based on a level of risk and potential return you feel 100% comfortable with. Let's say if you want to retire in 20 years with $100,000 in your bank account and $5,000 to invest, you'll have to include fewer fixed income investments and more stocks. Some financial advisors recommend building a conservative 60-40 portfolio, 60% for stocks and 40% for defensive assets. Generally, this is a good ratio for low-risk investors, as you don't put too much investment capital at stake. However, there's no hard and fast rule when it comes to diversifying your portfolio. Some investors prefer going 70-30 for more profits, or even 20-80 with 80% in stocks. As long as your investment portfolio contains a good mix of stocks, bonds, real estate, and commodities, you're good to go. Thumbs up, medium skin tone. The role of stocks in diversification chart increasing. Stocks are often the choice of many beginner investors as they are easy to buy and outpace inflation. At best, they grow with the economy, providing hefty dividends and high returns after holding on to them for a while. However, they are also subject to market volatility, company performance, and other factors outside your control. Without proper research and consideration, your stint in the stock market can be short-lived and leave a financial scar for life. Instead of putting all your eggs in the basket of fast-growing tech stocks, try mixing your portfolio with other sectors like healthcare, entertainment, and automobiles. Each sector has its ups and downs, so having a healthy distribution of stocks across all sectors would maximize your gains and reduce the risk of losing everything. The first instinct of many investors is to invest in stocks of giant companies like Apple or Google since their profits are almost guaranteed. But knowing how to invest in smaller companies can multiply your profits as there's more room to grow. Additionally, you can also invest in the foreign market to capitalize on growth, especially if the US market is stagnant. Using bonds to diversify money with wings. While bonds typically have higher entry requirements, they are the preferred non-correlated investments as they're usually more stable and secure. In case of liquidation, bondholders, you would be paid out before shareholders. You would also know roughly how much you'd receive when your bond matures. On the other hand, many investors often overlook higher interest rates in exchange for financial security. You may also not get as much as expected when your bonds mature with high interest rates and inflation. Not only that, but bonds typically require a much more significant investment sum and are less liquid than stocks. If safety is your priority, your best bet is to purchase some AAA bonds, considered the safest type and almost always yield. Bonds are rated from AAA to C, with BB and lower, junk bonds, having higher yields due to higher default rates. Diversifying with exchange-traded funds, ETFs, currency exchange. ETFs are one of the most popular assets for passive and risk-averse investors. They are much like mutual funds as they are a package of securities consisting of various stocks, bonds, or commodities. As the name suggests, this asset class is traded during the day on the exchange. Just like a diversified portfolio, it's unlikely that all the fund's assets will plummet at once, making it a much safer investment option than stocks. Additionally, some companies also offer dividends to their investors, which they can channel back into the fund or cash out. Exploring different types of ETFs bar chart. There are 6 types of ETFs: index, sector, commodity, active management, international, and inverse. Each type has its characteristics, strengths, and weaknesses, so choose those that best suit your financial goals and risk appetite. 1. Index ETFs. Index ETFs aim to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Strengths: they provide broad market exposure with low expense ratios and minimal management fees. Weaknesses: they may underperform the index due to tracking errors, and they lack flexibility for active management. Dos sectores ETFs. Sector ETFs focus on specific industries or sectors, such as technology, healthcare, or energy. Strengths: investors can target their investments in sectors they believe will outperform the broader market. Weaknesses: sector-specific risks can lead to higher volatility, and timing the market within a specific sector can be challenging. 3. Commodity ETFs. Commodity ETFs track the price of a particular commodity, such as gold, oil, or agricultural products. Strengths: they provide exposure to asset classes not typically available to individual investors and can act as a hedge against inflation. Weaknesses: commodity prices can be volatile, and commodity ETFs may not directly track the spot price of the commodity due to factors like futures contracts roll costs. For active management ETFs, active management ETFs are actively managed by fund managers who aim to outperform the market through stock selection and timing. Strengths: potential for higher returns than passive index ETFs if the manager successfully identifies undervalued securities or market trends. Weaknesses: higher management fees compared to passive ETFs, and there's no guarantee of outperformance. 5. International ETFs. International ETFs invest in stocks or bonds from foreign countries, providing exposure to global markets. Strengths: diversification benefits by spreading investments across different countries and currencies. Weaknesses: currency exchange rate fluctuations can affect returns, and geopolitical risks may impact foreign investments' performance. 6. Inverse ETFs. Inverse ETFs aim to profit from declining markets by using derivatives or short-selling strategies to generate returns that move in the opposite direction of the underlying index. Strengths: they can serve as a hedging tool to protect against market downturns or as a way to profit from bearish market sentiment. Weaknesses: inverse ETFs are complex instruments with higher risks, including leverage and potential for significant losses if the market moves against the investor's position. When selecting ETFs for your portfolio, consider your investment objectives, risk tolerance, and time horizon. A diversified portfolio may include a mix of different ETF types to balance risk and potential returns effectively. Can you diversify with gold? Sports metal. While it can be volatile in the short term, gold has a history of maintaining its value over time. The price of this asset class also typically rises when bond and stock prices fall during recessions, making it an important part of a diversified investment portfolio. Many investors tap into their inner smog and hoard physical gold when, in reality, they may cause more problems than they're worth. Instead, you can try investing in a variety of gold ETFs and gold mining stocks. Although there's always a risk with gold, especially when it comes to gold mine production, this is an excellent asset class for medium to long-term investments. Real estate investment trusts REITs House. A REIT offers the opportunity to earn income through partial ownership of commercial real estate, such as apartments or offices. However, with REITs, you not only own a portion of the property but also receive a small share of the income generated by the occupants. Many investors liken REITs to stocks since they're quite similar, but REITs are also required to pay out 90% of their net income to their shareholders. This means you get income from owning a REIT unit plus the money generated by the unit's renter. While it may not pay your mortgage in a month, it brings in a stable cash flow, making it a good defensive option in a diversified portfolio. You can also opt for diversified REITs, which contain various types of properties. How to diversify your portfolio card index dividers. There's no one-size-fits-all way to diversify your portfolio. Your investment portfolio works for you if it provides profits and matches your risk appetite. You can even use your Sheldon Cooper-like powers with different apps and formulas to diversify your investment portfolio if you wish. Here are some tried and tested tips you can use to diversify your portfolio. Own at least 10 stocks in every sector heavy $. Many investors put all their chips in one lucrative and high-reward sector, such as technology, industrial, or pharmaceuticals. However, investing in several companies within the same sector doesn't count as adequate diversification, as you're practically screwed with an unexpected event, such as an economic crisis. You can use naive or ideal diversification to choose which stocks to buy. Naive diversification simply means you follow your gut and select stocks randomly. While not very sophisticated, it can be an effective strategy if your decisions are guided by experience and thought. The ideal diversification is usually calculated with algorithms and programs to find assets that are less positively correlated with each other. Although more accurate, it is much more complex and likely beyond the average investor. Invest in foreign markets. Banknote. Investing in foreign stocks or those with foreign exposure can significantly diversify your portfolio. On one hand, you can minimize your portfolio's risk as foreign stocks are less likely to be positively correlated with U.S. stock price movements. But the main reason to invest in foreign stocks lies in expanding your opportunities, since you can take advantage of growth in foreign markets if the U.S. market is stagnant. Historically speaking, domestic and international stocks alternate in performance, meaning foreign markets are very likely to outperform the domestic market at some point in your lifetime. For example, while U.S. large-cap stocks recorded a return of 22% in 2017, the MSCI EAFE, essentially the global S&P 500, performed much better, with 25.6%. So, if your capital were invested only in the U.S. market, you would have missed out on the extra profit. Allocate a portion of your portfolio to fixed income investments. Bento box. As mentioned earlier, it's essential to diversify your portfolio with fixed income assets like bonds or gold. Although they won't lead you to the first million, they're typically great investments to reduce the overall risk profile of your portfolio. The fixed income/equity ratio depends on you, but the risk increases with the percentage of stocks you put in your portfolio. On the other hand, you'll also see lower potential annual returns if you decide to invest in more defensive assets. Don't neglect market laggards. White heavy checkmark. It can be very tempting to invest all your money in market leaders that are almost certain not to be faced by crises. But look at it this way: how much would you have earned if you had some Apple stocks from the 1990s? Having small companies and market laggards in your portfolio is as crucial as holding blue-chip stocks. Some of these overlooked or out-of-favor stocks have the potential for high long-term profits while presenting relatively low risk, especially if you have the vision to see what they could become in the future. Rebalance your portfolio from time to time. Person juggling medium dark skin tone. While a well-diversified portfolio doesn't require constant monitoring, it's certainly not a one-time thing. As bond prices constantly change, you'll need to rebalance your portfolio and put it back on track from time to time. Depending on what you want to achieve and how risk-averse you are, you may sell the best-performing ones for new funds to reinvest or invest new capital in newer assets. There's also no right way to rebalance your portfolio as long as it helps you achieve your financial goals. How to diversify your 401k counterclockwise arrows button. When allocating your 401k, you're directing the money you contribute into the investment of your choice. Regardless of your risk tolerance and reward, you should continuously diversify your 401k so that your assets don't become overly weighted in one sector or company. Target date funds directed. One of the easiest ways to diversify your 401k is to invest your money in a target date fund geared toward people planning to retire at a specific time. These funds distribute your 401k money across various asset classes, including large-cap stocks, small-cap stocks, emerging markets, real estate, and bonds. Target date funds make long-term investing with an end date much easier. If you plan to retire around 2050, you should choose a target date fund with 2050 in the name. You don't need to do anything other than continue contributing to your 401k after investing in the fund. It does everything for you. Another benefit of using target date funds is that it automatically shifts your contribution among asset classes in a way that supports your retirement goal. The closer you are to the target date, the more conservative it becomes. This way, you would have a nice nest egg waiting for you at retirement age. Although designed to reduce investment risk, there's always the risk of losing your money. So, before investing in a target date fund, you should always ensure that you're 100% aligned with your plan, the gradual investment of your 401k. Balanced funds balance scale. You can use a balanced fund to diversify your 401k if you're more conservative. A balanced fund is a mutual fund with a more conservative mix of bonds and stocks. Typically, it would consist of 60% of your 401k in bonds and 40% in stocks. It's a low-risk, moderate-reward approach since you won't worry too much about market volatility. No matter how the stock market performs, you'll still have some security as you hold more bonds. The downside is that you also won't see overwhelming returns on your funds when the market is booming. And since the goal of using a balanced fund is to minimize risk, some investors play it too safe, resulting in meager returns. Benefits of a diversified portfolio. Thumbs up. There's a reason why the finance world considers portfolio diversification one of the safest strategies. When done correctly, a diversified portfolio provides the necessary peace of mind, minimizing the risk of losses, and maximizing your profits without needing much intervention. By concentrating all your capital into a single income source, you're depriving yourself of the opportunity to earn more with other assets, besides exposing yourself to too much vulnerability. If the asset you're betting on performs poorly, you're essentially losing all your investment capital. But if your portfolio is divided among several other securities, the loss won't affect you as much. Moreover, you can tailor your portfolio to align with your financial goals and risk appetite. With regular rebalancing, you can adjust your portfolio to reflect where you are in your investment journey, i.e., being more conservative near retirement age or actively accumulating when receiving a large work bonus. A diversified portfolio would also give you more liquidity as you can shuffle your securities as you progress. Besides being able to cut your losses and move on, you'll also be able to reinvest profits or reallocate your assets according to market movements. Limitations of a diversified portfolio prohibited. Diversifying your portfolio is a kind of golden rule in the investment community, but that doesn't mean it doesn't have its disadvantages. For one, you can get overwhelmed with the large number of securities you own. It can also take a while to set up your ideal portfolio as you'll need to see how each asset performs relative to the others. Diversification can also be very costly since not all securities cost the same, i.e., bonds and REITs have a much higher initial investment than penny stocks. Not only that, but you'll also have to bear transaction fees and brokerage fees resulting from the mistakes you make. One of the most common pitfalls new investors face when diversifying their portfolios is over-diversification. By spreading out your investment capital too much, you risk filling your portfolio with underperforming stocks that hurt your portfolio's earnings potential. On the other end of the spectrum, risk-averse investors may end up holding too many bonds with meager returns. Conclusion. Checkered flag. Congratulations, you've reached the end of the article. Ultimately, portfolio diversification is an essential investment strategy that every savvy investor should know. By allocating your assets wisely, you'll be protecting yourself against unexpected losses and have a better chance of coming out victorious. Flexed biceps. I hope this article has been useful for you to understand the importance of portfolio diversification. If you liked the content and want to receive more investment and personal finance tips, don't forget to subscribe to our channel and like the video. Stay tuned for upcoming updates. See you next time.